As we are approaching the 10th anniversary of famed investment bank Lehman Brothers collapsing and pulling the global financial system into a global crisis, I'm here with Thomas Ritter, a founding partner of Multiplicity Partners. Multiplicity is a Zurich-based investment boutique that is specialized in providing liquidity to holders of private market funds and distressed assets. And Thomas is the partner in charge of the distressed asset side of the business, which deals with a broad range of illiquid, so-called toxic and exotic assets. And unlike others in the market, Multiplicity focuses on smaller positions and prides itself on its end-to-end execution approach. Now, before we dive into Thomas's take on what, if anything, the market has learned from the Lehman debacle, let me start with a very personal question. What were you doing on that infamous 15th of September 2008?
I still remember that day quite clearly and vividly. I happened to be in Melbourne, Australia at the time, attending a conference. And I think the morning after, with the time difference to New York and European time, we quickly realized, both from a personal but also a business perspective, that the world would change.
How did you get into dealing with distressed securities in the wake of Lehman?
That was first-hand experience in that we had also exposures to different Lehman products and financing structures. So we learned the tricks of the trade and the intricacies of dealing with assets in distress and later in liquidation, literally on the day and the years following the bankruptcy of Lehman Brothers.
What has fundamentally changed in the banking system since then?
I think change in the banking system has been manifold. I think we need to differentiate between the USA and the European markets. I think a general statement that can be made is that banks are safer today. So tier 1, for example, capital ratios have increased by about 2/3 in Europe and about by 1/3 in the US. That has also led, however, to lower returns on equity. If you have to hold more equity, capital returns go down. Banks do hold more capital. Today, the banking sector as a whole has shrunk in terms of the size of the banking sector and the banking assets to GDP, or also the size of banks or the bank stocks in the S&P 500, for example. Funding structure has changed of banks, so it's more a equity and deposit-based funding structure today versus more risky overnight short-term funding measures that were used in the past. Banks as a whole are also a general statement are conducting less risky business. For example, trading revenues at Goldman Sachs have decreased from 60% in 2006 to a mere 37% in 2017, I believe. That shift went line in line with new activities or new focus being put on wealth management businesses that require less capital and generate more steady returns, but also more boring returns. So I think banks struggle to achieve the pre-crisis rates of return on equity.
If we look at your recent paper on the state of the distressed asset space, you suggest that distressed asset buyers have lined up and are really keen on buying distressed assets. What picture does that paint?
I think you need to look at that from a sell side and a buy side perspective. The mere fact that record amounts of capital flows into secondary funds, not necessarily only distressed funds, indicates that that there is still a lot of illiquid and or distressed assets out in the market, and that the banks, especially in Europe, are still in the middle of the process of cleaning up their balance sheets. Mm-hmm. We see a lot of asset management companies for example, funds who still hold sizable amounts of illiquid positions that they may or may not want or need to sell at this stage.
I gather that now seems quite a good time to look into selling distressed assets if you have them in your portfolio.
With now 10 years having passed since the famous September 15 event, the failure of Lehman Brothers, yes, we have gone through a remarkable recovery. Stock markets again reach all-time highs. Markets in general seem to be stable. Economic growth is picking up. In such a benign economic environment, and also if you break that down to an individual portfolio, if your performance is satisfactory, then you're more inclined to offload your problem assets, as opposed to when the traditional side of your investment business is not performing so well. And on the buy side, clearly with the amount of capital waiting to be deployed in these illiquid and or distressed assets, it's a good environment to sell your distressed assets now, because pricing that we observe across different types of illiquid and distressed assets has improved remarkably.
In that context, you have assembled a short reading list of articles that we will try to post with this recording, and also there will be a post of the Multiplicity, or the link to the Multiplicity Insight article that we referenced before. Thanks for taking the time to talk to us.
Thank you.